Okay, so if you've been anywhere near the news on trusts lately, you've probably heard that trusts are dead, that the government's going to tax them, that you should be pulling all your dough out of them and shoving it into a company before it's too late. So let me say this right from the start. Cool the jets, calm the farm, and take a chill pill. I've been doing this a very long time, and I can tell you the taxing of trusts everyone's worried about. It's a budget proposal in May 2026, but it's not law. It's out for consultation. And even if it does come in, it doesn't start until the 1st of July 2028. There's a set federal election before then in May 28, and the opposition is already starting their scare campaign about scrapping it. Discretionary trusts have been around in Australia for a couple of hundred years, and they've never been income taxed like this. So we've got 2 years of this playing out and nobody knows yet how it will land. What I'd say is the worst thing you can do right now is panic, tear apart a very good structure that's working for you because you read a headline. In this video, I want to walk you through why I'm still setting up clients on discretionary trusts today, right now, with all of this going on. Let's start with the simplest reason. If you hold a growth asset in a trust and you sell it, you get the capital gains tax discount. Same if you hold it in your own name. And if you hold it long enough, greater than 12 months, you'll get that discount on the gain. A company doesn't get that and never has got that. And under the new rules coming, it still won't. A company pays tax on the full gain every time, no discount ever. Now I know the CGT discount itself is changing for trusts. From the 30th of June 2027, it stops being the flat 50% and moves to something based on inflation. But even with that change, a trust still is getting the CGT discount and a company won't. So the gap doesn't close. It's still the trust that comes out in front when you go to sell a growth asset. And that gap matters most at the point of sale. The company might look cheaper while you're building the wealth up because you're only paying 30% along the way. But when you go to sell something and take the money out of the structure, that missing discount costs you. Let me put a rough number on it so you can see it. Let's say you buy an asset for $100,000 and years later it's worth $200,000. Let's call it a publicly listed share. So that's a $100,000 gain. Hold that in a trust and you get the discount. So you're taxed on $50,000. At the top rate, that's $23,000 to $25,000 in tax. Hold that same asset in a company, there is no discount. The whole gain of $100,000 is taxed at 30% or $30,000. And even then, the company hasn't got the cash cleanly into your hands yet, because to pull the rest out, you're into top-up tax on top of the original tax of $30,000. This dreaded top-up tax is likely to be between 15 to 40%. Ouch! That top-up tax is part of what's doing the damage, and it's where we want to talk about next. A holding company is where the government wants you to invest in growth assets. And it's good at one job only, the holding company, letting you build money up in it at the lowest tax rate possible. You're paying 30% along the way, and the money sits in there and grows. If that's all you ever did with it, fair enough. Put it in a company. The trouble is getting the money back out, because the way money comes out of a company is as a dividend. And in most cases, that dividend gets taxed in your own hands. If it's a franked dividend, you're up for another 10 to 15% on top of the 30% the company's already paid. If some or all of the dividend is unfranked, and it often is once you've sold it, you could be up for 40 to 45% tax. So you've already paid 30 inside the company, and then you pay more on the way out. There's really only one way around the silent and dreaded top-up tax, and that is to liquidate the whole company. Wind it up, pull everything out at once, and you can get the money. But nobody's doing that when you've got another 9 or 10 investments within that company. You can't burn the whole structure down by liquidating and getting that one asset out. Companies do not work like that. So the company works right up until the day you actually want to use the cash. And I've watched what that costs in top-up tax. I had a client years ago, this is going way back to the 90s. Yep, I've been around a while, got plenty of the grey matter to prove it. Anyway, he was developing a property, block of land, build a property, and I asked him straight, are you going to hold this, Jimmy, or are you going to sell it? Jimmy said, Pat, I'm selling it. I said, fine, leave the property in the company. Then, a couple of years later, he changed his mind, decided to hold the property. And by the time he finally sold it, 7 or 8 years down the track, that property was in the wrong structure. In a trust, he'd have paid around $2,000. In the company, he paid about $40,000 in that silent killer top-up tax. It was the same asset, the same sale, and the only thing that changed the tax was the structure it was sitting in. And you can't fix that after the fact, because by the time the sale comes, the structure's already decided what you're going to pay, which is exactly why I don't like locking everything away in a company early, because you can't know today which asset you'll need to sell in 8 years or why. And you'll need to sell something eventually. That's the part I try to get across to our clients. Somewhere in the next 5, 10, 15 years, something happens, a life event. You sell the business, someone comes along and offers a great purchase price for that business, you have a business partnership split, a personal relationship split, or worst, you get unwell or you have a family member that's unwell. So the reason I hold as much as I can in the family trust is that it keeps the choice open. When one of these life events lands, we can move the money at a moment's notice and it makes sense. We can still pick up the capital gains tax discount on the growth up to that point. A company doesn't give you that timing, the trust does. Let me give you a real example. I had a client, I'll call her Julie, wealthy Julie, and she had about $5 million on publicly listed investments in managed funds. This was sitting in her family trust and we advised back in 2016. And for years, I'd been distributing on paper to her bucket company, but I kept the actual cash and the investments in the family trust. I told her that the money does have to go to the bucket one day, but not yet, not until we've got a very good reason. Then early this year, 2026, 10 years time, 2 things happened. She went through a family separation and it was finally the right time to move that money across as part of the family financial agreement of the split with her partner. So we moved the money. We rang the financial advisor, changed the names on the investments from the trust to the bucket company. Not expensive. That original $5 million investment had grown to $10 million by 2026. And because those assets had been sitting in the trust for years, it got a 50% capital gains tax discount on all of the growth on the way through. We saved Julie between $800,000 and $1 million in the dreaded top-up tax we would have paid if we'd invested through that bucket company. If that money had been in the company the whole time, there's no discount, any of it, none. The only reason the timing worked is that the trust let me, as the tax advisor, wait until the right moment instead of forcing the hand years earlier and just putting it in the bucket. And let me tell you, every client of ours is different. I'm not saying do exactly what Julie did, wealthy Julie, because her situation isn't yours. Every situation's different. So the only way to know what's right for yours is to get advice customized to your specific situation. The capital gains tax discount and the timing are the money reasons, but there are a couple of things a trust does that have nothing to do with the tax on a sale, and they matter just as much for the kind of clients that we work with. The first thing is asset protection. When your trust has a company as its trustee, you get the same protection you'd get from any corporate structure. So the assets sitting in there aren't hanging off you personally. The second is what happens down the track with the next generation of your family, because you can change who controls the trust when your kids are settled, and generally that's somewhere around 35 to 40 when you think they're settled down. You can move control of that trust across to them, and you've effectively separated part of your estate off for them cleanly. Living estate planning. Companies work differently, and they never get that capital gains tax relief along the way either. And then there's the income side. A trust lets you decide who gets what each year. So income can flow to a family member on a lower rate. I'll be straight with you, that benefit isn't what it used to be. The rules have tightened a bit on that, but it's still there and it's still part of why the structure earns its place. So even before we're talking about selling anything, the trust is already doing work for you that a company just isn't set up to do. Now, I said at the start I'd be straight with you. So let me tell you where the government pushing companies has a point, because they do. Eventually, money does have to go to the bucket company. That's how the system works, and I'm not pretending otherwise. The money must go there. Once the money is genuinely done growing, once you've had your life event within 10 to 15 years and you've cleaned things up, the company is where a fair amount of the money ends up sitting, and that's fine. It's meant to be there. I like to use a rough rule of thumb when working with my successful small business clients to see if I've done my job as a dedicated tax advisor. 60% of wealth in trusts, 30% in the bucket company, and about 10% in super. Now, there are situations where the company is the better answer from the start. If someone's genuinely going to build everything up and then sell the whole lot in one go, the entire lot, a holding company is the way to go, and it will work fine, because at that point you can wind it up, take the money out, and still get your capital gains tax discount on the way through. The problem I've got with it is that it's rarely how it actually plays out in the real world. Most of the time, people want to sell one thing, not everything in their structure, and that's where the company catches you every time. But if that clean, sell it all exit really is the plan, I'm not going to sit here and tell you a company's wrong. For most growing businesses though, the structure I keep coming back to is a company doing the trading, fair enough, with the growth of that business held in the shares by a family trust. The company runs the operation and the trust holds the value that builds and builds over time. The point I want you to take away isn't that trusts always win and companies always lose. It's that this is a decision you make client by client, situation by situation, and right now, with everything up in the air, the trust is still doing the job for most of the people I sit across from. So don't blow up a structure that's working because of a proposal that isn't even law yet and mightn't survive the federal election in 2028. So if you've got a structure of your own and you're sitting there wondering whether it's actually set up in the right way or whether all this trust talk in the news means you need to change something, that's exactly the kind of thing we work through with our clients. Every situation is different, and the only way to know what's right for yours is to look at it properly. There's a link below to book a time with us. If you want us to take a look at your setup and tell you straight whether it's doing what it should, come and have a chat.